Greg, we are seeing a lot more volatility in the market. So what do you think is behind it? Is the thinking that valuations are getting, lofty? Is it worries about inflation or something else?
Well, it's probably more of a class that we're getting closer to the end of a cycle. Markets are at all-time highs, and I think that would surprise a lot of people when you think back 18 months ago when we were entering the pandemic. We had a market's dramatic sell-off of 25, 30%. And really, there was a lot of money thrown at it from banks and central governments, and that's gotten us to where we are now, which is back to all-time highs. But we all know that stimulus has to start to end as the
Mhm.
central banks are going to start taking that away. Governments are going to start pulling back on some of that. And I think that's the nervousness that's going to start creeping into the market is, well, the question is the economy strong enough to go on its own? So that's going to cause some volatility as we get some puts and takes moving between different economic data points to see if how the economy is doing. So it does feel like we're entering a stretch where it could be harder to make money in the markets. Certainly, they're not expected to go up every day, which we've had for the last 18 months. And I think as we get into this period into year end and early next year, as we deal with the Fed starting to talk about tapering and taking off stimulus, it's going to create some volatility. And I think that's something investors need to be aware of. But it's not the end of the world. Volatility is normal in stock markets. And it's more that we're entering a more normal period than the abnormal period we've been in the last few months.
What do you advise investors right now that are heavily weighted towards equities? And do you see better opportunities in the US versus Canada?
Well, if you've been in the equity market for the last year, you've probably had a really good stretch. Markets, as we said, are back to all-time highs. So it's probably not a bad time to question whether you want to lock in some gains. If you're overexposed in different areas, you probably want to take off some risk and maybe go into more defensive, more areas that are going to be less volatile if we do get this period of volatility. So it's probably a time just to reassess, think that we've had a really good run, but do we want to lock some of this in? And whether we want to go to the US or Canada, that's a big debate.
Yeah.
Canada's normally been viewed as a late cycle market, and that's due to the commodities and financials, which are sectors that do better at the end of the cycle.
Hmm.
But the US market, when you look at it, is really interesting because this whole phenomenon of the new tech companies, FANG's been a big area of people looking at. But when you look at the Facebooks, the Amazon, the Apples, these are really the new defensives. These companies have massive balance sheets, good dividends, and they're almost more secure than the government. So it's probably not a bad idea to keep some of the portfolio in these big cap US stocks because they are the new defensives and might be able to weather some storm if we get that coming forward.
Greg, what do you tell investors who are searching for yield? Because this is so tough for so many people unless they're willing to take a risk, which really is not ideal for those who have less risk capacity. And I say this from someone, your purpose focuses a lot on trying to create innovative products to solve some of these problems.
Yeah, yield's been a big frustration for a lot of investors is you're not finding it in the traditional sources that you used to be able to. You used to be able to buy a GIC or a government bond,
Yeah.
and that would yield above inflation, and you'd be living happily ever after and don't have to worry about it. But that's not the case right now when you've got 10-year bonds yielding 1.3, 1.4%, and inflation in the 2 to 2.5 or higher range. So you're actually losing money investing in government bonds versus losing purchasing power versus inflation. So you've got to look in different areas. Dividend equities have done well, but as we mentioned, we could be getting into a period of volatility. So while there's attractive yields, you might take on some price risk. So what we've seen a lot of people do over the last few years is move into different products, which are something like structured notes, which are areas that are linked to the equity markets, but
Mhm.
will pay an attractive yield in the 5 to 6% range, sometimes higher. And it'll also give you some downside protection as it's linked to equity markets. So people are looking at structured notes, looking at different areas because the traditional sources of yield are just really not there anymore.
Can you explain structured notes? And I want to just bring up a board right now because Purpose has launched a Purpose Structured Equity Yield Plus portfolio. It's a mouthful, but at PSY Plus.
So what we've done with structured notes is, and the traditional structured note is a note that the banks will create linked to an underlying index. So you'd reference an index and you'd buy it at that point in time. There's always a term to these notes, which is usually 5 to 7 years. But then there's also a barrier that you have that's usually up 5% to down 30%. And
Okay.
then what they do is if you're within that barrier, you will get a coupon, kind of a reward every 6 months if you're in that range. And at the end of the period, if you're within that range, you get all your capital back.
Okay.
So it's a really innovative way to get access to capital, get higher yields because they are yielding 5 to 8% across the board.
Right.
The problem for investors and advisors is that if you ever breach that upper barrier, which we've had quite often in the last little bit, you actually get called. So all your money gets returned back to you.